Finally, that takes us to depreciation. You'll have depreciation again in every problem in almost any company that you ever would work for. And it's kind of a little different animal than the other ones. If you remember that matching principle, where we have to match those expenses to revenues, the idea of depreciation is when you buy a kind of what we call a long-term asset, meaning one that will last you longer than a year. So you buy a house, you buy a building, you buy a car. You want to expense the original cost over the useful life of the asset because you want original cost to be expensed over the period revenues are, we'll say, generated. So if I'm going to buy a delivery van and I expect it to deliver my flowers for a florist for 5 years, I want the cost of that delivery van to get expensed over the period that it's delivering flowers, because that's my revenue generator. Why buy equipment? And again, the other part of this, rather than just rent it, you buy it again because you have more control. You buy a building rather than renting it because you can paint it any color, you can modify it any way you want. It's the same reason you'd buy a house rather than rent an apartment. It just gives you a lot more control over what you want to do. If you think about if you rent it, by definition, you would expense as used. So it makes some sense that if I buy it, we should do the same. So we shouldn't be penalized for buying something or not penalized. We really want those two things to end up being the same thing. So it doesn't make any difference if we get a building to use, we want to expense it as it's used. So that's the idea of depreciation. We're just going to take that original cost and spread it over the period that we're going to use that asset. It is a systematic way to expense the original cost over the period revenue is generated. What depreciation is not, and this is kind of like the words debit and credit don't have anything to do with what you think of when you see a debit card and a credit card. Depreciation is not what people use the term for when you're just chit-chatting. It's not, I've got a car and I drive it off the lot and now it's depreciated by $8,000 just because the fair market value of it has gone down the minute you drive that car off the lot. That relates to the fair market value, has absolutely nothing to do with what accountants mean as depreciation. It is not the reduction in market value. It has nothing to do with market value. Again, it's just how much of the original cost you've booked as an expense. We're writing down an asset on our books, has nothing to do with the market value. Don't ever think that's what it is. And a problem with that, theoretically, is what that means is on your balance sheet, your long-term, especially, your long-term assets are not shown at market value. They're going to be shown at original cost minus depreciation expense that you've taken to date. So, if I'm smart enough to buy that piece of land where the QT is over by Home Depot and Target, that corner was pretty much nothing when they bought it. And so they bought it really cheap. Now that corner is a gold mine if you've ever tried to get gas at the QT. And so it's really gone up in value. We don't recognize it on the financial statement. It probably is showing at zero for the building, at least, because it's been there long enough. It's been depreciated totally. So it's showing on their balance sheet as zero, and the land is showing at the original cost, even though it's worth a whole lot more now. So when you look at a financial statement, for those of you going in finance, that's a really important thing to remember, because when somebody's looking to get a loan, whatever the value of the assets on the financials are has nothing to do with the value of the item itself. So I'm going to go ahead and buy this used van for my flower shop. I think we're going to use it for 3 years. We just guess. We make an estimate of how long we think it's going to last. So we think it's a used one. We think after 3 years, we're going to put a lot of miles on it, delivering a lot of flowers. So on March 1, when we buy the van, we're going to debit van or motor vehicles or whatever we want to call it. I'm going to call it a van, and cash for $36,000. We think we're going to use it for 3 years, which is 36 months. We made this so we could hopefully divide that in our head. So at the end of every month, I'm going to expense it. And the credit is the hard part. We're crediting an account called accumulated depreciation. We usually even say what that matches to. And 36,000 divided by 36 months. Hopefully you can do this in your head. I don't have to show you. That's $1,000 a month. Accumulated depreciation, we'll often abbreviate that way. So make sure when you do it, I can tell it's an AD, not an account payable. But that's our new account. And that's a special kind of account we haven't talked about before. That's a contra asset account, which means it's an asset, but it subtracts from another asset. So it has a credit balance. So that's what we mean by a contra asset. And the reason we do that is we want to know that we actually spent $36,000 for the van, and we don't ever want to mess with that. But we still have to do this depreciation expense. So we want another little column to keep track of how much we've expensed on that van. So on the balance sheet, the way we would show this is under the asset side, we would have van for $36,000. We would subtract our accumulated depreciation. So that would be minus 1,000. And that will give us our van, and we call it net, the net value of the van. On our balance sheet, we'll show the van value of $35,000, not a market value, just the balance that we haven't depreciated. And that just means I've got $35,000 I've got to write off over the next 35 months. The depreciation expense goes on your income statement like every other expense, so nothing weird there. That's all there is then to your adjusting journal entries. Just to summarize across the 3 videos, adjusting journal entries are just to get things in the right period. The book talks about these terms, and even seasoned accountants get these mixed up, but accruals are adjustments when the cash has not been transferred yet. So that was, I think, the second video where we accrued the wages and the interest. We haven't gotten any cash, we haven't had a transaction, but we're making a journal entry. So we accrue things. Deferrals are adjustments when the cash has already been transferred. So those things that we talked about in the video with the insurance and the memberships, where cash has already gone either back or forth, and now we have to figure out where they go on the income statement. On almost all of the journal entries we've done, if you go back and look, one of the entries goes to the balance sheet and the other goes on the income statement. So here, again, I've got an expense here That's on my balance sheet. We're just moving stuff between the two. There's no real transaction that happened. Nothing really happened at all. And one of the most important things, the one account that is never ever used is cash. Because again, this isn't a transaction. This isn't a regular journal entry where something happened and now we have to make a journal entry. We're just moving stuff around. So if you're doing a journal entry that's an adjusting journal entry and you don't know what to put as a debit or a credit, pick any other account other than cash. Don't ever, ever, ever use the word cash in adjusting journal entry. It will always be wrong.